Hello, everybody. Randall Cornett here, and I have a very special guest, one that I would consider personally, and this is my opinion, one of the kings of the Reddit DD. A lot of his DD I've leaned on heavily in terms of kind of finding out what's going on with some of the more advanced stuff that's regarding to AMC and our, hopefully a impending short squeeze. And with that being said, I've got True Demon here, and I met True Demon through, if you guys seen one of my original videos with the Vigilant Watch, it was the Popcorn for Bonds video. I was actually the reason that I even stumbled in that loophole or that rat hole was because of True Demon. So he's provided a lot of very strong DD, and one of the more recent ones that we're going to be covering in this video, he's spotted some pretty unique trends when it comes to AMC, so we're going to cover that here. So thank you so much for being on the channel with me, True Demon. I hope you're having a great day.
Thanks, Randall. Glad to be here.
So what we're gonna do is we're gonna pull up, I guess, your DD, and I'll just pretty much let you take the floor. Obviously, I'll ask questions if I have it, but I'm just kind of giving, and I told you this before the video, I want to give the most simple breakdown so people have an understanding or a clear understanding, because there is some pretty advanced stuff.
Yeah, absolutely. So the essential breakdown of the due diligence that I did here was I was looking for trends that explained correlations with price increases or price dips and what sort of data kind of was ahead of that. And a lot of it had to do with failures to deliver. And a lot of apes are familiar with failures to deliver, but specifically I'll go over it here. Failures to deliver is when a broker or some member of trade settlement fails to deliver shares to the buyer. And that could be somebody who was holding a call option, or it could be somebody who was lending stocks that were then shorted into the market and then wants them back, but then the broker fails to deliver those shares back to the lender. So every time there was failures to deliver spikes, we saw that there was a coinciding price increase. The problem with failures to deliver is that we don't know when they happen or when they go like through the roof, because they're reported up to 20 days after the fact. So it's kind of useless to us. It's just a way of looking back in the past. So I went looking through all of the data that I could possibly think had something to do with failures to deliver. And what I found is there are patterns in the charts with the data having to do with short interest, shorts on loan or shares on loan, and interestingly, short exempt.
Well, you and I have talked about, and this is something that I've covered in multiple videos because I think it's a really important thing, is, and we've talked about this off the air, about, the short increase of numbers. And so that's some very interesting stuff. So why don't you take us a little bit, number one, before we get too ahead of ourselves, how did you decide that you were going to look at that? So like, how did you identify the trend? Could you kind of walk us through that?
Yeah. Interestingly, I was simply answering someone's question when they asked me, "How can you tell when shorts are actually covered?" And I didn't have access to Ortex data, but I did it. I went through my community and asked someone who did, which happened to be Vigilant Watch, who you interviewed before. He provided me with a full chart and gave me as much data as I wanted, and other members of the community contributed too. But when I looked at the data, I specifically went and looked through this chart right here. I created this in order to point out, okay, this is how you can tell shorts are increasing. You see a drop in the average days on loan and a sharp rise in shares on loan. That makes sense. There's more shares going on loan so that they can short, and then the average days on loan drops because you're adding to that average formula. Now, if you look at the other side of it, you see average days on loan dropping and the shares on loan dropping. That tells you that they are returning shares and they are taken out of the average formula. So it's relatively simple algebra. You just look at those two trends and you know that there's somebody covering. So you see this price increase. There was a bit of covering that took place between February 24th and March 19th. So that was what led me to creating this chart. But as I was looking at it, I was like, hold on a second. There's a pattern here when I look at the FTDs. So I see these spikes in FTDs, and there tends to be a 21-day cycle, and then followed by that 6-day cycles as they slowly go down. And I'm like, there's a pattern here between the spikes. So I marked out the 21 settlement days, or the T21 settlement days, and the T35 settlement days, and we can go into that detail a little bit later. But you can see there's spikes and ebbs and flows in the FTDs, and that's what made me go looking elsewhere for data that followed these trends, but not just following it, staying ahead of it, and data that was public and updated daily, because that was going to be what told us when there was going to be a spike in FTDs coming up soon. And that would let us know when a price skyrocketing was on the horizon.
So you're basically, and again, I have to preface this by just to cover your ass and my ass too. Like, this is all just basically taking the data that True Demon is seeing and basically putting his theory on it, right? And just looking at the trends. So obviously, when we cover this stuff, we don't know for sure that there's going to be a price spike when you see this, but the historical data shows, and if we're just following the way that the trends move, that's what it looks like. And sorry, I just wanted to preface that for people that are watching as well.
Yeah, absolutely. And maybe this is probably a good time to say, like, I'm not somebody who is deep into finances. I'm relatively new to the stock market altogether. I don't even do this for a living. My actual job has nothing to do with finance. Um, I just play with computers and code all day, and that's what I do.
You know, what's funny that you say that is because a lot of I feel like the brightest people that are contributors in terms of good due diligence all have some sort of like programming or computer degree. And I've talked to people that are in finance and some of these space calls and stuff, and they've mentioned like, hey, I've got a degree in finance. In the 6 months that I've been involved in this, I've learned more than I learned through my entirety of like going and getting a degree. So I don't think that's, you know what I mean? Obviously that you're a smart man because you're identifying stuff that, you know, when I look at this chart and when I looked at it originally, I'm like, holy shit, like, how did I not see this? Right. So I think that you're definitely on the right track.
I appreciate that. It was really, it was really interesting how many people looked at the information that I was providing and just going like, look at this, there's an exponential growth in FTDs. Doesn't that seem a little bit weird? And everyone's like, huh, I never noticed. And I don't know. I don't mean to sound like superior when it comes to that stuff. That's not me. I don't like to do that. But it's something that I think that I am good at enough in seeing trend of data and doing a little bit of analysis, just counting a little bit of head math to sort of point things out that other people might not notice, and put it into as simple terms as possible so that everybody can be on the same page and we can move in the same direction. Because that's how you make a tidal wave. All the drops of water go in the same direction.
100%, 100%. So, okay, getting back to the chart, you've identified a trend. You said, hey, look, I can see that the FTDs are, you know, in a really a certain pattern or increasing. And I'm seeing that there's potentially some covering going on. And when you see that trend, it looks like, you know, the stock is basically, the AMC is making its pops. So moving forward now, where do you see us at now? Or let me, I guess, jump back into, because I didn't mean to cut you off. I just wanted to make people know that this was, you know, obviously we're just going off of what the data is telling us. We don't really know for sure which way, you know, something's going to go. But obviously, right. I just, you know, wanted to make that clear.
Yeah, I totally understand, and you're absolutely right. So I guess with that in mind, we can jump back into the actual data. So what I was looking for in this is, like I said, a predictor or some metric, some piece of data that was filled in, that would fill in the gaps here and let us know. Because like I was talking about, there's these little 6-day gaps where there's nothing, there's no FTDs, and then they start to climb again. And it happens over and over and over again. And I'm thinking to myself, like, is what would cause a 6-day repeating cycle? So I started looking through the reg show documents, and I found out that market makers operate they have to settle failures to deliver on a 6-day cycle. So I'll jump out of this chart very briefly, and I want to I need to go a little bit into the way that market making and the mechanics of the stock market work in order to explain this. And I know that this is really hard to follow for everybody. It's really it gets confusing very quickly. It's a complex set of systems, and the language of the regulations does not help at all. It is designed to be confusing. It is meant to be as vague as possible so that people are not able to understand it, and it's done that way deliberately. I firmly believe that. But let's go over it really quickly. So, like I was talking about here in my due diligence around failures to deliver, there's a relationship between brokers, market makers, and the clearinghouses. The brokers are who we deal with. We do our exchanges with them. They handle our money and our shares. That's their job. So they broker transactions. Market makers have the role of making the market. They handle transactions and they make money off of what's called the spread. That's the difference in price between the bid and the ask. Whoever is that's what somebody's willing to buy for, and that's the ask is what someone is willing to sell for. The spread is that gap between. The market maker makes their money by taking a seller or taking a buyer, and as soon as they see that transaction up for grabs, they take it right away. And they'll be like, I will get you your share, or I will get you your money for that share. And they take it into the market. They go find a buyer or a seller for a better price, and then they deliver that share back to that individual. And then they keep the difference. So they keep the money on the spread. That's fine. That's how market making works, and it has allowed our economy and our stock market to operate so quickly. We currently operate on a T2 settlement cycle. That's the date of the transaction plus 2 days. And that's how much time it takes for shares to go between accounts. We get the shares added to our account digitally, instantly by our broker, and that's what we see when we make the payment. But the share doesn't actually get to our account until 2 days later, or the money doesn't settle into our account if we sell until 2 days after that transaction takes place. So does that all make sense so far? I'm not rambling too much.
No, you're definitely good, and I appreciate that. I think just for even people on the very basic level in terms of understanding the market maker side of all of this, I think that was a really good entry explanation for sure.
Yeah, great. So failures to deliver have their own transaction settlement cycle. Failures to deliver operate a little bit differently because they happen for a variety of reasons, but the one that everybody's been focusing on is naked shorting. Because whenever you naked short, you're basically you're selling a share that you claim to borrow without ever locating it. And I want to make it clear, hedge funds don't do this. It's not hedge funds that actually know for certain whether they're taking a naked short. It's actually the brokers. The brokers are responsible for locating the shares on behalf of their customers, including hedge funds. So they can collude, they can cooperate to do naked shorting. That absolutely has happened in the past, but it's the broker's responsibility to locate the share. So I want that to be clear with everybody when they look at this, that they know that the broker's settlement cycle is what's important here. So when a broker lends out a share to a hedge fund or whoever, and they say, go ahead, you're good to short. The hedge fund goes to them, say, I want to short this stock. The broker says, go right ahead. And then they go looking for a share, and lo and behold, there's nothing to borrow. So that creates a failure to deliver, and it's a naked short. That's just one instance where a failure to deliver can occur, but that's what we're focusing on. The broker dealer or the broker bank gets 15 settlement days in order to satisfy that. Now, a broker dealer has a cooperative agreement with market makers. So their settlement cycle of T+6 gets added on to this. And you can look at this in Reg Show, but the market makers they have 6 days to settle a failure to deliver. Here's the reason this happens. When somebody wants to short a stock and the broker fails to deliver that, after the T+15, they are forced to deal with the failure to deliver. They tend to go through the market maker in order to do it. And the reason why is because the market maker is constantly trading back and forth shares. And market makers are in a unique position where they can take what's known as a short exempt. They are exempted from locating a share right away in order to make the market. Because when a market maker takes the other side of your purchase, when you buy a stock, they go, okay, I'm going to short a stock. I'm shorting this stock in order to deliver your share. And then I'll go into the market and go find another one for a better price. So they frequently use shorting or borrowing and shorting in order to take the other side of that trade. So when the broker has a failure to deliver, then they go to the market maker in order to close it. They find, because the market maker has sufficient liquidity, that's cash on hand, and the ability to short the stock without having to locate it. And because you are allowed, and this is also in Reg Show, in this documentation, that the broker-dealer is allowed to borrow a share to close a failure to deliver. And the market maker also has this condition where they're allowed to borrow a share in order to satisfy a failure to deliver. So that's what creates that T+21 settlement cycle. Still on track so far?
Yep, I think so. I'm following perfectly, and I assume the audience would be as well.
Okay, good. So what happens when, after this T+21 settlement cycle, what happens if the failure to deliver doesn't close? Well, that's a worst case scenario for the market maker, and here's why. When you fail to deliver a sufficient amount of shares that cause such a high amount of failures to deliver, then the market maker or any responsible party, they're put into restriction from shorting the stock. This is an automated process, or it's supposed to be an automated process, where they are no longer allowed to short at all. For the market maker, that's disastrous. They cannot allow that to happen, because if they aren't allowed to take a short anymore, then they can't make the market, because they have to borrow shares in order to deliver on buyers' trades. So now you can kind of you can grasp
right. It's like it's
significant.
The way that I put it is like, I just think, and I understand it from if a market maker is being responsible, right? I understand it, right? Like, it makes sense because that's how you keep the integrity and the health of the market going. I just think that, again, and this is just saying that the possibility of collusion right now and irresponsibly handling, short exempts, or maybe doing things that are a little bit more on the nefarious side, is where we run into issues.
Right. So let's explore that nefariousness a little bit. When the market maker finally performs a failure, when they finally close their failure to deliver, they're probably also doing it with a borrow, especially in the case of a naked short. So what happens when a naked short finally has to go to the clearinghouse? Because that's the last stop for every naked short. Because remember, when you're naked shorting, you're basically creating a share out of nowhere in order to make it exist and deliver it to somebody. So the last stop is the Depository Clearing Corporation. As an example, it's not the only clearinghouse, but it's the big one. You have all these failures to deliver that will finally make their last stop at the DTCC. And the DTCC's role is to settle trade transactions. Basically, when we finally make our trades, that T+2 settlement, what happens is those transactions get collected, and then a sum of money is tabulated for the value of those securities or the stock, and it gets sent to the DTCC. That's called clearinghouse funds. the clearinghouse takes those transactions and they settle the accounts and decide where the money goes and where the shares go, and then they send it out to their various market maker accounts and the broker dealers accounts, and then finally the broker sends the shares and the money to their customers, according to how the trade's supposed to be settled. If you have a naked short, though, the DTCC receives liquidity, they get money, but there's a transaction that's imbalanced, and there's a share that has to be delivered that doesn't exist. Now, the DTCC has an additional role in the stock market of maintaining a record of all the digital security certificates, the actual stock certificates. Now, the DTCC has, over the course of time since digital stock market operations went to computers, where they removed almost all paper certificates. And you can read this in Atobit's House of Cards due diligence. When the DTCC finally... Go ahead.
Well, I was going to say, because at one point, and I thought I was like the smoothest brain person out there. I'm like, I figured it out. Like, why don't collectively we all just demand paper stocks? You know what I mean? Like physical copies of the stocks. Won't that show, like, expose how many, synthetic shares they are if we all, requesting an actual hard piece of paper? But because of that, the way that everything is digitized now, it's not, or digital, it's just not really something that's feasible.
Yeah, it's not. And it's funny that this was done I feel like it was done very deliberately. And in this due diligence, you can see the link to the Wall Street conspiracy. It was actually a documentary on the process of naked shorting and how the DTCC was involved at the end of it. And I really encourage everybody to watch that documentary. It really does a good job of telling you who the key players were in the stock market, how it played a role in the stock market crash of 2008, and how companies came to the understanding of how this was being done to maliciously destroy companies. I'll sum it up
the
here.
link. Yeah, we'll include the link to the DD, which has that link in there as well, in the description below too. So everybody, you make sure you guys go and check that out.
Right on. So I'll quickly sum up what the finding was with the Wall Street conspiracy. So when the DTCC has to settle a trade for a naked short, they have two options. The DTCC can choose to basically take money out of their own accounts in order to satisfy the material or the funding requirements to settle the trade. And they go and borrow a share out of their own pocket, pay for it, and deliver it to to who it is owed. Or they just create one, and a new share exists, and it's written into the books, and suddenly there's a new digital share. There's the only two options. There's no other way around it. Either you have to go and find a share to deliver to someone, or you have to go and create one. And the DTCC and all the other clearinghouses that maintain the records for the securities is really only the DTCC that has this power to just create a share digital.
It's unbelievable.
So it really is, because when you look at how long this has been going on, and it's been going on since the early 2000s, maybe even during the dot-com boom of the 1990s. I was too young to even remember that, but it nearly destroyed so many companies. And in the wake of that, companies were just they were totally imploding. And it's speculated that naked shorting had a lot to do with it, because Reg Show never existed at that time. Reg Show wasn't even discussed until 2005.
It's like the wild west, man.
It really was. So at the end of the day, you finally have a situation where you've got market makers and brokers and hedge funds that are able to collude with each other in order to maliciously short a stock, in order to drive it into bankruptcy, because their stock goes to a value that's basically, it's useless because it's cents on the dollar. So they can't raise funds by issuing new stock because their stock's worthless and nobody wants to buy it. So they can't build capital to do business, and then they're forced to go into bankruptcy. It happened with countless companies that had absolutely life-changing technology and medicine. Um, look into companies like Virogen or Eagle Tech, and also in the Wall Street conspiracy, and you'll see all the evidence in the record showing of how they were destroyed, and it almost destroyed Overstock. It's nearly destroyed all kinds of companies. Look at Toys R Us. You'll find all kinds of companies. The list is endless of how many that were shorted to the point where their valuation went to zero, and
It was all.
everybody that was holding the bag was just completely wiped out.
I mean, if it was not for us, shit, it might have happened to AMC and GameStop too. You know what I mean?
Yeah, I agree. And that's exactly what the purpose of all of this was, is because at the end of the day, the way that they profit off of this is when you naked short a company, or when you short a company at all. If that company goes into bankruptcy, its value goes to zero, but the transaction never settles.
Yeah, you can
You
wash
just
your
get a
hands from it.
credit. You wash your hands from it, but worse, you don't pay taxes because the transaction's never finalized. So it doesn't enter the tax records, and you don't have to pay any taxes, no capital gains or anything. The short, because the stock ceases to exist, you can't buy it back. It's gone. So the money that you were credited to your account is just given to you. And because it's a short transaction, to close a short, you must buy it back to return it to someone. If that never has to happen, then you never have to pay taxes on the transaction. It's a loophole in the tax code.
Jeez.
Yeah. So it goes really, really deep. But
That was something I was unaware of. I didn't know didn't have to pay the taxes on the money, even if, like, I knew that you could
yeah,
kind of get away from. Well, because this only, I would imagine this process that they're doing, the goal being is probably just that. Now that I know that, I mean, that's what you would want to do, is drive the company complete, like, that's best case scenario. And that's why I think
exactly.
it's so dangerous where we're, like, territory they were in, is that when you've got, behemoths, like, when it comes to the money these guys have, and then you have something that is motivating them or driving them to, like, try to fulfill that destiny of actually, like, closing the doors of companies. I just can't see how they can turn a blind eye to this. But this even brings me more to the idea that, look, we're shedding light on all this. You know what I mean? Like, it's getting to the point where it's unavoidable now.
That's what people thought in 2008 when Reg Show was finally written into the SEC regulations, and it did nothing. The threshold securities list became a new concept at the time. All it served to do was to just list the victims of the companies that, the victims of hedge funds, basically, that were being naked shorted. Because when there were enough failures to deliver, I think it's 0.5% of the total
Right.
outstanding shares of that company fail to deliver after a certain number of days. It goes on the threshold securities list. All it does is just list the companies that are getting absolutely reamed. What purpose does that serve? So then they were forced to write into the regulation that after it's been on a regulation
Right.
threshold
You're gonna
security
be
list,
forced to close that son of a
that
bitch.
you'll be forced to close the FTDs automatically by selling securities, basically a margin call, and it's enforced by the SEC at that point. So that's what eventually got written into it, but it wasn't enough. It was too little, too late. It didn't save hardly anybody, and the naked shorting continues. But anyway, that it's a bit tangential, but also has so much to do with what's going on. Um, so back to the chart that I was describing here. At this point now, we know how the market making works. We understand how the T+6 settlement has to do with all this. So when you see a 6-day gap in spikes like this one right here, there's a short, there's a massive shorting event, price goes down, and FTDs spike on that day. And then there's 3 days where it goes down sharply and then rises up again, just in time for T+21. So there's another 6-day rise. So we're looking at market makers when we see this 6-day pattern. When we see a 6-day gap in FTDs and then a spike or a slow rise to a spike, we're looking at the market makers that are clearly not delivering on shares. And it's important to recognize that the FTDs are cumulative, meaning that on the day of record, this is the total number of failures to deliver that exist for this stock on this day. So they don't add up over time. it's like it's not this bar gets added onto each bar. This is the total. So it's this amount goes into this bar, and then any new FTDs get stacked on top. I hope that makes sense.
Yeah, it does. It does. Yeah, it does.
Okay, cool. So now we're looking for a 6-day cycle in all of this, and it all has to do with the market. So that's what brought me to looking at how is the market maker involved, and what allows the market maker to continue to short. And this has to do with both the short sale restriction or the circuit breaker rule, and short exempts. So short exempt data was, interestingly enough, not on Ortex. I didn't find this anywhere except by going directly to FINRA's website in order to look at the data. And what I ended up finding is that there's a correlation between the short exempt data and failures to deliver. It's a very clear correlation when you stack them on top of the same chart. So first I'll explain, what is a short exempt? A short exempt, as Investopedia describes it, is a short sale that's exempted from the uptick rule regulation. But it goes much, much farther than that. So the only organizations that can do a short exempt are market makers. And the purpose of a short exempt is that in what are called, quote, rare and unusual panicked markets, a market maker is given an exemption to short a stock even during the SSR, which is the uptick rule. So they can continue to short a stock even though it's on SSR, and even during a downtick, which is when the short where it's already being shorted. So that's okay, I guess, because it's supposed to be a rare circumstance, right? It's very unusual. But I dug into Reg Show even further. So when I looked at the Reg Show language for short exempt, these are the actual conditions which constitute the necessity of a of a short exempt. A short exempt can happen when there are no shares available to borrow. So if the market maker must take a short in order to complete the other side of a trade, they are permitted to deliver a share that they have not borrowed and short it. That sounds a lot like a naked short. So they also have this condition where there's widespread panic buying in the market, such as a short squeeze or a gamma squeeze or any kind of squeeze, or even if there's just a little bit of FOMO on the day, they can do this. And then if the stock is already on the short sale restriction list, then they have clearance to qualify for short exempts for the whole day. If it's on short sale restriction list, then during a downtick, they can say, we have a transaction that we must short in order to complete it, and we must take an exemption. So that's another interesting component. And then finally, a market maker can short exempt under what it decides is necessary, under conditions that it considers sufficient. So that basically means that the market maker says, I have to take a short exempt because I decided I need to take a short exempt. So I don't know what the hell the SEC thinks that is doing, but like that's like the fox watching the hen house to me.
Literally, it says that. So I actually have covered the short exempt stuff in a previous video, and that, to me, the part that you're highlighting right now was the most interesting thing to me. It was like they said, basically off of their own judgment is basically what they say they can deem something short exempt, right? And they also said that there's no regular audits. There's not really any sort of oversight, like, and if they do come in and they decide, hey, we want to ask about this or whatever, if the market makers participating in it, as long as it meets up with their criteria, like their self-defined criteria to like, I guess, match or be on, to be short exempt, it's good to go. You know what I mean? Like nobody's asking any questions.
Yeah, exactly. And the audits, like, we don't actually know what conditions constitute an audit. I would have thought that by now, with all of this craziness is currently going on, that the SEC would have already kicked in Citadel's door to go and ask them, what the hell is all this? Because the short exempts are through the roof. But
yeah.
Oh well.
Yeah. It's about, yeah, that's one of those other things that I love that one of my other friends, Wired, always talks about is like sometimes, like, I think it's very important that we're armed and educated. And that's why the work that you do is so crucial. But sometimes it's really important. And we've talked about this too, worrying about the controllables, right? So things like, me and you have talked about fidelity before and about, payment for order flow. Those are things that we can control, right? And this stuff is really just making sure that we're armed and educated in terms of just having a very good understanding of what's going on against us.
Yeah, exactly. So in this part, I dove into the actual reg show language on the locate requirements. So here's the difference between the market maker and the broker. The broker is required to borrow the security in order to short it, or must have reasonable grounds to believe that the security can be borrowed at a later time so that it can be delivered on the proper delivery date. If they fail to do that, it's a failure to deliver. If failures to deliver for the broker goes too high, they get a fine, basically, because they're not delivering. They have to, so they're breaking rules. With the market maker, though, the locate requirement does not apply to them when they are engaged in, quote, bona fide market making activities. So whatever the hell that necessarily means is up to the market maker. And that goes back to them defining for themselves what constitutes market making activity. So they don't get caught unless somebody goes in and audits them and decides that that wasn't legitimate market making activity. And an example of this is when market makers do something which is extremely illegal, is to trade ahead of their customers. If market makers are trading ahead of their customers out of their private accounts, and they're like, say somebody's selling a stock, they can buy it up and put it into their own accounts and enter it on their books, in order to accumulate the money, or accumulate shares, I should say, and then make money by selling it as it's going down by hiding those buys. And it's basically a speeding ticket. The fines, it's a stupidly small amount of money. It can be as little as $10,000 when they're making millions on the trades. But anyway, that's only one piece of it. So here in the highlighted sections, as I described it in my DD, this is the infuriating part that will make you want to go burn Wall Street to the ground. Is the rules for closing out a failure to deliver position. In order to close a failure to deliver, you have to buy a stock and send it on its way to the clearinghouse, right? No, not the case. You can borrow a share. But what's interesting is that the market maker's already exempted from the locate requirement. And they're also exempted in this situation. They don't have to locate a share in order to close a failure to deliver. So they take a short exempt and then they deliver that share that doesn't exist. So they basically cover a naked short with another naked short. And I should have prefaced this by saying that this is speculation because I can't prove it. There's no way to know unless they've been audited and they actually go and check the trades to make sure that they borrowed a share. But in the language right here that the SEC drafted themselves is that the market maker is totally exempted during panicked markets, and that they can deliver with a borrowed share, but they can deliver a borrowed share that they never borrowed. Where is the logic here? So this is the part that finally just threw me over the edge. It's with blind rage over the way that the market mechanics are working.
Well, and I know what people are thinking right now. They're like, "Shit," you know what I mean? It's like we're in a rigged system.
Absolutely. But there is an end to it at some point, and the end of it is liquidity. Um, at some point, the market maker is put in a situation where their clearinghouse is going to be like, "You are so underwater with delivering us shares that don't exist," and it becomes the clearinghouse's problem. So that's what NSCC, I think it was 2012-08. I'm not positive, but there was a requirement that the market makers were going to be forced to make liquidity deliveries whenever they had failures to deliver over an excessive amount. And it was basically like, if you're going to naked short, it translates to this. When you are naked shorting in order to cover failures to deliver, you're sending us money. There's no more question about it because we're tired of paying your bills. because it falls on the clearinghouses to provide the liquidity to the market and deliver money to the sellers and deliver shares to the buyers. And if the shares don't exist, then they have to make it exist. And when they do that too much, that's when it starts to get everybody's attention, and it starts to bring the SEC into it to put a stop to it. Now, when that threshold gets reached is what's going to decide when the mother of all squeezes finally hits.
Right, when it just kind of brims over the edge. You know what I mean? And like I said, I think that it's getting close. And I think that it's a lot of contributing factors too. Like, again, the attention that we're giving. And then you have all these people working on it. And now that the media is getting involved and stuff, it's just, there's just so many more eyes on it where, like I said, I tend to like, and I know, like you mentioned in 2008, it didn't seem like, there was a whole lot of, good that came from it because we were getting a lot of attention then, but I also don't think that there was as many brilliant minds like you and everybody else that's contributing that is also throwing this like the information out there. So one thing is like, hey, going out there and having our signs and out there protesting, but I mean the information that's being exposed, and a lot of it is publicly held information that just I just didn't think that we would be seeing a spot, or even like you and I talking about, reg show shit. You know what I mean? So I think that eventually it is going to get too big for them to manage.
I agree. Social media has everything to do with this as well, because in 2005 through 2008, when this was coming to a head during the housing market crash, or the upcoming housing market crash, Facebook was brand new. There was no Reddit. There wasn't Twitter. All of these things just kind of came out of the millennial generation that were creating online platforms for people to reach out to each other and also create their own media centers. That didn't exist then. So we had to rely on mass media through news, which are corporations that are owned entirely by closed, very rich families, like the Fox News Corporation is all owned by one family. And then you have CNBC, MSNBC, who else is there? There's CNN. They're all owned primarily by investors and hedge funds. They're owned by their shareholders. So guess who dictates what stories they're publishing? And it's been that way for decades. So, like, they're not going to publish a story about Occupy Wall Street or anything like that unless they do it to make us look like we're insane. And then that's what everybody sees at home when they're relaxing at the end of the day, is a bunch of idiots that are throwing their signs and screaming and chanting about fraud. They see crazy people standing in the road, being an annoyance. They don't see the actual movement. Social media changed all that. And that's why we have the power now. We have the ability to reach out to millions of people in an instant and catch all the eyes of everybody that actually has the power to change it. And I like to quote Bug's Life. Those little ants outnumber us 100 to 1. And if they ever figure that out, then there goes our way of life.
I love that. I mean, that's what it is. That's what this is. And that's what's happening right now. I think that like we're waking up. And like I said, I think it's easy especially for me, because I'm so involved in AMC, but there's other people that are just as passionate or convicted about like GameStop and, or whatever because it's not just us two, even two. I know that we're the biggest of the two, but there's other people that are feeling the same way. And so I think that like I said, they've awoken a sleeping giant, and they're going into a territory that I don't think that they've even charted for. And I think that's why we're seeing some of these rules get passed out, and it's almost like panically getting thrown out or trying to get rushed to approval because, everybody's trying to get rid of the hot potato. Nobody wants to get left with it,
Yeah, absolutely. And somebody's going to be holding the bag, and the DTCC is like, it's not going to be us. It's definitely not going to be us.
Get that shit out of here.
Yeah, because let's be honest, if the DTCC collapses, then the stock market itself collapses. There will be zero confidence in the United States stock market at that point. So that's actually what we're dealing with right now.
And that's like the worst case scenario for them, I think, is if the world loses faith in our markets.
Yeah, but more so that's the Fed's problem. Now the Fed has to get involved. And if the Federal Reserve comes to the realization, and this has to do with reverse repos, which we won't get into, but The Federal Reserve is holding on to a whole bunch of bonds that they've traded in exchange to give banks all their liquidity and print a bunch of dollars that don't exist. And now we're worried about hyperinflation and craziness like that that's going to threaten to crash our entire dollar. And at the same time, we have a whole bunch of hedge funds that are customers of these giant banks that are getting all their liquidity from the Federal Reserve that are way in over their heads, that are deep underwater because they decided to do this fraudulent bullshit. And now I think the banks are now in they're kind of in this Mexican standoff now with the Federal Reserve and the hedge fund customers, because either they give the hedge funds the money to keep doing this, and then I don't know, I don't think that they trust the hedge funds to do the right thing and close their positions. I think that they're like, if we keep giving you money, then you're just going to keep making the same mistake. We don't trust you anymore. And if that happens, then the hedge funds go under, but then all of this money from the elite gets transferred out into the economy. And God knows the rich don't want that to happen, and the rich are some of the owners of these banks. So there's a serious conflict of interest through the entire financial industry right now. There's conflicts of interest all over the place, and it's a rigged system. Absolutely.
Yeah, and I 100% agree. I mean, we're seeing it all firsthand lay out in front of us. It's weird because, not weird, but I feel like we're literally on the battlefield and really seeing it. And it's like, I'm almost feeling like when I talk to like family members and friends, like I'm awakening them. You know what I mean? Like, you guys don't understand what's really going on. And I really do feel that way. I feel like we as apes are really the ones that are like looking at this like, holy shit, like, why is anybody talking about this? And obviously we just covered some reasons why. So before we get too off track, because I know that we'll probably could end up talking for hours about that. So let's get back to the DDs where we kind of are talking about, okay, so we covered there's a correlation between the FTDs, the price, and obviously we covered the short exempt stuff and kind of how that's playing a role in what's going on, especially from a market maker perspective. And so now where are we at now? So what does the data tell us?
Yeah. So like I was saying, we're trying to track a way for FTDs, for us to predict when FTDs are going to spike, because FTD spikes tend to coincide with massive price moves. So what we're looking for is to make a prediction of, okay, this is some data we can look at today, every day, and we can know if there's probably going to be a huge spike in FTDs shortly thereafter. We have that with short exempts. When the short exempts go up, and I'll show this chart really quickly. This is the actual chart that I built. So we have the blue lines, which are new shorts. This is new shares on loan. And then the yellow is the FTDs, and then you got these little black ones, these black lines that represent the short exempts. So short exempts are comparatively small. Keep in mind, short exemptions are supposed to be extremely rare. They tend to make up less than 1% of the total short volume on any given day for normal trading circumstances. When you looked at, this is AMC's chart, where the green line is the prices. You see that when the FTDs went up way early in November, there was a price move that coincided with a rip on the short exempts. This was a very sudden, pronounced increase. Before, the short exempts were less than 10,000. Suddenly, on November 10th, the short exempts went well over 1.2 million. I think this is actually 1.4 million. And then let's count the days. 1, 2, 3, 4. Suddenly there's a spike in FTDs. It's within 6 days. It's not necessarily 6 days, but 6 days is the maximum limit where the failures to deliver must be delivered. And they can happen for a variety of reasons. This may have been because options needed were failing to deliver. But in any case, the failures to deliver went down, but they stayed pretty high. We can assume that the short exempts are because the market was extremely volatile. AMC jumped up by a full $1 and they had to make the market. Okay, that's pretty normal. It's a unique circumstance. We keep following the trend. Suddenly we get these spikes in the short exempts, but the price is going down this time. And now we have spikes in FTDs again. And that starts to trend downward. We follow this pattern where eventually we see this meteoric rise in failures to deliver. Now let's look at the 6 days preceding the squeeze. Short exempts over 3.8 million. 1, 2, 3, 4, 5. And this is squeeze day. Suddenly there's 27 million failures to deliver. And the price went up to its maximum peak of $22. The reason why I'm paying attention to the short exempts and these huge rises is because they're a predictor of the volatility, and it lets us know just how much market makers were scrambling in order to settle trades. If they're in a situation where they can't locate the shares, then those become failures to deliver that then must be closed. But it's interesting that the short exempts happened at their highest on the same day that all of these failures to deliver occurred, 6 days before the actual squeeze happened. So that
Absolutely crazy,
that shows a correlation here. But let's not get too ahead of ourselves. Let's actually like track it down. So the short exempts kept going way higher, like days after. Okay, this is because of the panic markets. Short exempts get even higher after the squeeze is already ending. So we can be very certain that once the short exempts go this high and the price is going down, that's market makers that are scrambling to settle trades, and a lot of it eventually does settle and they deliver on the shares because there was selling going on. Apes were panicking. People that were trapped in their positions decided to sell in mass. So unfortunately, that did crush the squeeze. Now, that it definitely had to do with Robinhood and the brokers halting the buys, but at the end of the day, the market, the holders panicked and they sold off. It's just a fact. So with this trend, we're looking for another situation where this continues to rise. Let's take a look at this one. Short exempts, 1.1 million. Next day, 2.1. Next day, 5.6 million. Next day, 6.7 million. And then the FTDs start rolling in and they start coming up really fast. This is a market. Let's track it a little bit further. We have these rises in the shorts. We have short exempts spiking throughout the week, throughout the weeks of March, and then the FTDs start to roll in over time. This is more likely brokers because they're a 15-day settlement cycle. After the FTDs go way down, then it gets handed off to the market maker. Suddenly, 2 days later, short exempts, boom, boom, up over 3 million again. And then after this week, the FTDs start to climb rapidly again. You can kind of track it with this dashed line. This is a moving average that shows you where the short exempts are on average for a 5-day moving average period. So when we saw this huge bump up back in March on the 13th, this coincided with shorts actually covering, and then there were no shares to borrow because utilization was maxed out at 100%. So for everybody else, utilization, that means that there's no shares to borrow basically when it's up over 100%. 100% utilization means every share that's loanable is out on loan and you can't borrow any. So then market makers forced to take short exempts and then they fail to deliver. And inevitably you get prices going up, prices go up higher, more shares fail to deliver as call options go in the money, and then more short exempts in order to deliver on those transactions. And it just has this runaway effect between FOMO, gamma squeeze, and a little bit of shorts covering. But if we actually look at the data, shorts just ended up going up even higher. All right, so finally we get to the point in the chart where AMC goes onto the threshold securities list. It had happened right around the time where we were bouncing off of this line of resistance near the $60 mark. So at this point, we can kind of assume that there were a ton of options on AMC that failed to deliver because if we think about it, AMC started down here below $12 and there were so many options that were open for calls deep out the money at $40 strike. And then as soon as we got to that level, they extended the options chain and it went to all the way up to $140, I think, strike price. And then everybody started buying those and all the strikes in between, and then it just kept rising. So this was pure gamma squeeze. And then all those options started failing to deliver, because as soon as those got put on the options chain, I guarantee you, market makers and hedge funds started making naked call sells. And then now they're scrambling to go and find all these shares in order to deliver them. So the threshold securities list, first day of that happened on June 18th. The shares failing to deliver exceeded 0.5% of AMC's total outstanding shares, which is it's mind-boggling how many failed to deliver. But let's just track with the threshold securities list. We know that it was on the threshold securities list for 12 days, and then it fell off. So all through this period, AMC's had to be above about 2.5 million. So 1, 2, 3, 4, 5, 6, 7, 8 days, and then we can assume that the failures to deliver stayed above this for another 9, 10, 11, 12 days. And then we look at the short exempts. Rapid climb in short exempts, and all these new shares getting borrowed, going out on loan. Remember, the market makers they're delivering a lot of failures to deliver. Brokers and market makers are delivering on them with borrowed shares, which if they didn't locate, that's just another naked short. It's just another FTD. It's an FTD on top of an FTD. So you're multiplying by 2. And we just keep seeing this trend of short exempts spiking up over 3 million. And it's important to also remember that we're way higher in price than we were back then. The market makers and the brokers are taking huge losses while they're doing this, because every time that they short it, they're getting a credit they're getting a temporary credit, but when they fail to deliver, if the market starts running away from them and it goes above where they borrowed it at, they're going to have to deliver at the market price. They don't get a choice, because at some point when they are no longer allowed to short and they're put into restriction by the SEC, they're eventually going to be so far underwater that they're forced to buy shares at the market price. And that's when algos take over. When we eventually hit that point, that's when all the trades start happening automatically and all of the failures to deliver get forcefully closed. We may go back on the threshold securities list. We may not. We're going to probably find out very soon here after the short exempts.
I was thinking that we're probably not gonna be off of it for long. You know what I mean? Like, I wouldn't be surprised to see us go back on there.
Yeah. I think I misspoke earlier when I said that the threshold security list, you have to be over that amount for 3 days. I think it's actually 5. So pretty soon, if the failures to deliver, we have to wait for a 6-day gap, because up to 6 days is when those shares start failing to deliver that they handed back for the failures to deliver. And that's on top of continued buying from apes. So because of that, the FTDs just continue to climb onto the ones that they already had. They're just kicking the can down the road by 6 trading days when the failures to deliver finally, they failed to deliver again. So now you got to go and deliver twice as many. So you're going to have to go buy shares at some point. Eventually, and it's going to be up to the SEC or the DTCC to finally say this is enough, and you're going to close out these positions. Somebody has to step in and do it. It's just a matter of who's going to be doing it first and who's going to be left holding the bag. But
somebody's getting left with it, not us.
Somebody's going to get left with it. Absolutely.
hopefully not us. I don't believe so.
Yeah. But we can actually use this. This data can tell us when FTDs are starting to climb out of control for them. So if they went off of the threshold securities list on, what was it, Thursday? It was the week Thursday of July. Was it July 7th? Was it July? I'll have to double check.
It's the 8th.
It was
July
the 8th.
Yeah.
Okay. Yeah. Right. Because the last trading day. Okay. Got it. So July 8th, was when we came off of the threshold securities lists, and then that means that the FTDs finally had to be delivered. So I'm suspecting they did that because they didn't want to go into forced settlement. But they're gonna fail to deliver again. So if we go from here, from 6 trading days after that, so here's day 1, 2, 3, 4, 5, 6. Short exempts start climbing rapidly again, and then 1, 2 days later, that's when the price spikes.
Yep. It's uncanny how
it's a repeating. It's a crazy repeating pattern. Like here, suddenly the price spikes up here. This is just FOMO buying or just pure buying. Okay, right here. Short exempts are high on the same day that the price goes up. But here, short exempts spike again. 1, 2, boom. They start climbing rapidly. So if we look at the short exempts and then go 1, 2 days later, and then from this one, 2 days later, keeps going up and up and up. And then on this day, it took a little bit of a dip, but then the very next day, it went even higher. And on this day, it skyrocketed all the way to the peak. So you can see there's a bit of lead time. There's a 2-day settlement lead on these massive short exempts. And I can't be certain, but if my understanding of the market mechanics is correct, that when the market makers are settling the transactions on the 2-day settlement cycle, they have to hold they're eventually having to start buying all of these shares, and then they take short exempts to deal with the amount of apes buying all the shares until they eventually catch up to a point where they can settle the failures to deliver and then dump all these shares back into the market once they settle them. If they get to the point where they can finally get ahead of it just a little bit and then shove the price back down, it delays things for them. They can make money on the way back down, and they can even make a little money on the way up. But by and large, they're very deep underwater. And all of these short exempts in this rapid ascending parabolic pattern is them just trying to keep up with the trades. But when we see them start to spike as the price begins to rise in moments like this, then we know that a rip is going to be coming very soon. There's just this repeating pattern of T plus 6, and then after that, T plus 2 price boom. And the best part is that the short exempts come out daily. Every single day at the end of the trading day, FINRA updates their reg show lists. So we can check them every single day, and we can look for these pops. So what I've been looking for is for let's just skip past all of this history. Everybody can everybody can go reading through each of those pieces of detail. I kind of just covered them now. But what I'm looking for in order to predict what the price is going to do based on these short exempts is I'm looking for the short exempts to spike up over. This is a typo here. I was not accurately accounting for the price change, but 3 million is what I'm looking for, not 5 million.
Okay.
But I'm looking for short exempts to spike up over 3 million and have a moving average above 3 million for 5 days. I'm also looking for utilization to be maxed out. I consider maxed out 95% and above because there's so few stocks available to borrow that puts them in a really tough position. And then finally, a 2 to 3 day consecutive increase in the price. If the moving average price continues to rise above 5% as these short exempts continue to rise, then it sets off my third trigger. So if we see all three of these at the same time, very good, strong sign that the market makers are losing control of the momentum and that it's going to start getting away from it. And when that happens, then it's time, at least for me, this is what I'm doing personally. I'm not financial advice. You probably shouldn't do anything based on what I say because I'm just another dumb ape.
Me neither.
I'm going to be buying some deep out the money call options for 14 to 30 days expiration.
So you're basically taking your theory, and this is all backed off of everything that we just had covered, and depending off of the criteria of those 3 triggers, you're basically using those as a gauge that when all three of those are met, that there's going to be some positive price movement.
Yes. The only one that I'm not entirely sure about is utilization, because they may not necessarily utilization may not necessarily have to be so high. It really depends on the liquidity of the market maker or who's ever put in this runaway position where they're trying
Right.
to outrun a freaking downhill rolling freight train. Um, if the utilization is high, that helps a lot, because then they run out of shares to borrow that are legitimate borrowable shares. But it definitely helps. So at the very least, I'm looking for short exempts to be really high and for the sharp price increase. And then utilization kind of puts a cap on their ability to short the stock with legitimate borrowed shares.
Well, True Demon, I'll tell you what, this is the first time that I've seen like historical data, like built in a, like kind of in a trend analysis perspective, where I like, after just watching this, and granted, I read the DD beforehand, but just because I'm, as much as I'm listening to you talk, I'm kind of watching, because again, you're sharing your screen, you're going through the data. I just feel like that I've seen it is pretty much in black and white, the trend, right? Like I can see it, like, and so to me, I'm tending to kind of, and obviously I'm going to dig into this more myself. I've already been looking at the short exempt stuff, but I think that you really are right on track.
Yeah, it feels really convincing. Like I want to be careful about saying that this is true. I can't say that this is true. I can't prove any of this, but there's history here. And they have a saying in the stock market that the stock market never repeats itself perfectly. It's not a mirror, but it does rhyme.
Definitely, I like that, actually. Never heard that before.
Yeah.
So now I guess that's pretty much the thick of it, right? Or is there anything else that we should be knowing about this information that you kind of want to take the viewers to take away from this as well?
Yes, I do. So I did a second part to this DD, and I'll skip most of this because a lot of this is recapping what I talked about in the first one, just to catch up new apes that didn't see it before, catching up and
Perfect.
making corrections on my observations. So the second part corrects that 5 million consecutive days, or 5 million short exempts over 5 consecutive days, and kind of goes into a little bit more detail about issues like dark pool volume and the floor ceiling pattern that I identified. So people can go read into that. But the main thing that I really want people to take away from this is this key takeaways section. So a lot of apes have been asking me and others what they can do to affect the squeeze. And this is, I'm not telling you this in a means to do any kind of manipulation. I'm simply educating you on what actions individual retail investors take that cause certain effects. There is cause and effect for every action that we take. So the first one is holding. Holding is the most important strategy that we have. It's what makes this work. This squeeze cannot happen unless bulls continue to hold, and there has to be follow through eventually. Enough people will buy, but as long as you hold, then you are helping it to continue, because every share that gets sold is a share that can cover a failure to deliver. It's a share that can be used to send a sell to the exchange, which is what affects the price. And every buy not being made on the exchange is going to a dark pool, or it's going off the exchange into a back order or a back end for a market maker, and it doesn't affect the prices. The second part is getting everybody off of payment for order flow platforms. And I know that this is very hard for everybody to do. I don't think that this is going to happen in mass, but I think it's important. And the reason is because of the relationship of payment for order flow between market makers and brokers. Market makers pay brokers with payment for order flow by sending our trades to the market maker. And market makers make their money by volumes of transactions. They make a little bit of money on every buy and sell. Doesn't matter which direction. But we think that because the market makers have the ability to route orders according to where they want the stock to be affected. They will send sells to the exchanges where the exchange dictates the price. So if they see selling, they see the price going down. And if they do buying in the dark pools where they don't affect the price, then the market maker settles the trades by acquiring shares through the dark pool, and then they deliver them directly. But the buying does not affect, it doesn't affect the tape. It just doesn't affect the price.
It's buying. Yeah, they're suppressing it. It's the best way I can think of
Yeah.
it.
Yeah, it's essentially suppression. Basically, the way that it works is the market maker will accumulate all the buy orders, and then they'll do the selling on the other side of the transaction in real time. But they accumulate the buy orders, hold them on the books, and I suspect they go into the dark pool, and then they do a block trade in order to get a massive amount of shares in a single trade, which is at a fixed price, and it doesn't complete the transaction until all the shares are delivered to the market maker, and then they deliver those to the clearinghouses for settlement. So that's my theory on how that
Yeah, I
mechanic
like.
works.
I mean, yeah, I'm definitely in the same ballpark of what my thoughts are.
Okay. So the third thing that apes can do is to disable stock lending. Stock lending is a tricky thing, and not all brokers are upfront about stock lending programs. Some of them require you to opt in. Some of them don't do it at all, and some of them do it and give you the money, and some do it and don't. They don't give you. There's all kinds of brokers that are doing stock lending by holding IOUs in your account, and then they do lending on the other side in order to continue making money on the side through borrow fees. Now, whether the broker passes that on to you or not is that's up to their fine print in their terms of service. But regardless, if there's any stock lending going on, it works against us. It's fighting our own. It's fighting. We are allowing our shares to be used against us. So in order to do something about that, you can opt out of stock lending programs, or if you find out that your broker is doing it against your will, or if they do not offer an opt out, then you have to basically transfer. I'm using Fidelity now. I used to use Robinhood, and then I moved from Robinhood to Webull, and then from Webull to Fidelity, because ultimately Fidelity does not lend out your shares at all. They don't even allow share lending unless you have $250,000 in your account. And they allow you to do something called direct market orders, which is the other part of this. So the fourth thing that we can do, we can get around payment for order flow. We can get around the market makers. It is possible. You can buy directly from the exchanges. This is called a direct market order. So even if we're not on a payment for order flow platform, it's important to recognize that Citadel is the world's largest market maker. That's just a fact. Everybody works with them. And they send most of their orders through them because they're the cheapest and they give the best fees. So there's no getting away from Citadel unless we directly buy from the exchange. Fidelity allows you to do a direct market order through the NYSE or the NASDAQ, and you can send your trade directly to the exchange. You pay a little bit more because the price of the NBBO may not necessarily be in your favor. The spread can be wider, but the trade happens on the exchange, and the exchange sees that buying pressure. It won't go to a dark pool, and that's how we get around it.
And then the fifth thing is something that I think is I can help with because I already know what it is, but spreading the word. You know what I mean? Like,
for sure.
That's to me is again, that's our powers in the numbers, and like we touched on earlier, the social media has opened up as a tool that I don't think that they've ever really had used against them in the way that it is right now. And like you said, the information gets spread in seconds. You know what I mean?
Yes, absolutely. And that's the kind of power that we have. We have the ability, unlike we have ever had before in our world's history, we have the ability to touch and reach the minds of millions of people in an instant. And even though you don't have much of a following, and even though you may not be able to reach many people, you do have the power to reach someone. And that's someone who, if you can speak to them and if you can get them to listen, they may have a following and they can reach other people. That's the power of social media. We are a network, and we are only every person in the world, 5 connections away from knowing every single human on Earth. I don't recall where that statistic came from. I believe it was LinkedIn, but
That's
Apparently, every
crazy.
human is connected by only a difference of 5 relationships. And that's an incredible thing. That if we can just make that spider web connected all the nodes, that we could reach every person in the world to teach them about what's going on here, and we can do something about it.
So I love it. That's 5 things, and we talked about this before we started. I love the idea of things that we can control, right? And these are 5 things that anybody can do, right? Like it's not this is not it doesn't take a special talent. It's not based off of theory or it's this is straight facts and it's something that's actionable. So if there's things that the Ape Nation you guys want to do in terms of getting your hands even more dirty in terms of like actionable things, there's 5 things right here that directly have an effect on where we're going. So I appreciate you doing that. That was really good. I actually hadn't read that part of the DD, the second part. I didn't know there was a second part, so I'll actually have to go through and read that myself.
Absolutely. It's worth reading through. I promise. I know that I get really wordy with my DD, and I know it's a lot to take in. And I know that the finance industry uses intentionally confusing terms that make things really hard to understand. It's done on purpose. But I promise I'm always going to be on Reddit to answer questions. I will be able to help give people resources. It's what I do.
Well, we're gonna do
So if
another
you
one
have
too.
questions,
Like
you
I
can reach
said,
out.
we might probably just we might cover this in a different video whenever you have some different time. We can cover the second part of this. I think that it's important. Number one, I want you to kind of shout yourself out. Obviously, I know that you definitely don't want to be on the forefront of everything that's going on, but you are willing to help. So how can the people find you? Obviously, you're True Demon on Reddit. Do you have a Twitter presence in terms of like, are you active on there answering questions, or do you prefer people to hit you up through Reddit? What's the best way to get a hold of you?
Um, So Reddit is the easiest way to reach out to me. I pay very close attention to the due diligence posts that I do. So if you want to reach out to me, I answer all the chats and everything like that. I'm kind of inundated at the moment, so if it takes me a while to get to you, I apologize. I also am active on Twitter. I usually use that to get news through the mass network of apes. My Twitter handle is TrueXDemon. You can find me based on my avatar. It's the same one that you see here. And those are the 2 easiest ways to reach out to me.
And so I
Um,
guess in closing too, because I think that it's important to understand that you are actively doing this. I mean, you are in the thick and thin of this pretty much every day. And the proof is in the pudding. So the fact that we have somebody and he's open, like you just said, and obviously don't go blow him up. But the fact that you have such a well of knowledge right there, make sure you guys are taking advantage. So if you have any questions about this data, that you make sure you can get it answered. Because I think, again, this is really, really the closest thing that I've seen so far that has been, able to give us some sort of idea what would be the future might hold, right? So this is going to be something that I'm going to put into my arsenal in terms of looking at the short exempts and how that lines up with the FTDs. And it's going to give me a better idea, I think, of what we're looking at as well. So I really appreciate you spending the time and coming on and sharing this information with us, man.
yeah, absolutely. I'm really flattered that you were willing to bring me on just so that I could explain this a little bit better and put it into words that everybody can understand and sort of get on the same page about. Um, and I want to mention one more thing.
Of
I'm
course, the
gonna
floor is
keep
yours.
I'm gonna keep I'm gonna keep updating this stuff. I'm gonna keep these posts uh, frequently updated with new information as I make them. So I'm not looking to get famous or anything like that, but if you want to keep track on this, it's a good idea to at least follow me on Reddit because that's where I issue new research that I find as I find it. I'm also going to make it a point to do daily updates on these 3 triggers. I was asked to do that, and I think it's a good idea so that everybody understands that actually believes that we might be onto something here with the short exempt data. So I'll tweet it out whenever I get the daily utilization and as I'm able to get the new information from my friends who actually can pay for Ortex.
I have, I will be able to help you on that front though. So, because like I said, it's going to be part of my arsenal as well. So As you get information,
Good.
I'll be sharing it as well. Like I'll be making sure that I direct people, because like I said, I'm a subscriber to the theory, man. Just after everything I've learned today, I'm be curious to see how it works. And like I said, if you guys are interested in this, it's right there. And I suggest, even though after the video itself, we've been talking about, the DD, I still recommend you guys actually go and read it yourselves as well, right? So you just are equipped with that information.
Yeah, and if you want to track the short interest data yourself, FINRA updates this page every day. It's regshow.finra.org/regshow-index.html right here, and you can
We'll
go
put
to
that
every
link in the
daily
description
page.
too.
Yeah, yeah, for sure. It's a really ugly page, but if you just Control F and look for AMC, there you go. You get the total short volume for the day, the short exempts for the day, and finally the total volume on the day. So that's how this file is laid out. You can look at every single day when it's published and track it yourself if you don't want to wait on me to take the initiative.
And like I said, obviously, I'm so surprised. There is like I did a video and just explaining to some people like how to even get started into like diving down the rabbit hole. And I had so many people message me, like people are hungry and they want to get their hands dirty themselves. So you're going to be surprised, but there's probably going to be a lot of people that'll start tracking this short exempt volume now, especially with the information you provided.
I hope so. And I did another one of these interviews with another much smaller YouTuber, Casey Shaw, that was very generous bringing me on to talk about this stuff too. But he mentioned bringing it up with Stonko Tracker, and I think that would be a worthwhile metric for them to track as well. If they were able to do it and put all the data in one place, all the better.
You know what? I'll send them an email. Not that I'm like have any more ability to get it done anyways, but if we all go and say, hey, we like collectively, we have a few people go message them and say, hey, look, we want this to be tracked. I'm sure it would be no skin for them to do that. And I think it's a great idea. Yeah. So that's awesome. That's a really great idea. I make sure that I'll message that. So if you guys want to see the short exempt data on there so you can track it, because I think that's really what it is, because like you said, that document's ugly as shit, you know what I mean? And people got to go to FINRA. If there was an easier spot to go and access that info, I think it would be certainly very helpful. And Absolutely. Shout out to Casey. That was nice of him to bring you on, man. We all got to start somewhere. So I'll have to go and watch the entirety. I watched the first little bit of that interview, but it was great so far. He did an awesome job.
Yeah, it was really flattering that he reached out to me to bring me on for this, and through much insistence of other members of the Reddit community that wanted to see this explained better. I'm glad that between you and him, I was able to do that.
Well, we're going to be able to bring you the exposure on it. Like I said, I think that it's deserved. And like I said, I'm not going to talk about stuff that I don't really believe in. And so I went through, and obviously I've read a lot of your stuff. Me and you have talked. I've been kind of tracking you for quite some time. So again, as much as you're flattered, I'm actually flattered. Like I'm happy that you came on, you took the time with me, because at the end of the day, the information is valuable, and I have an audience here or a platform for you that if I can spread any sort of information that it's going to help us, that's my main goal. So thanks again for that.
Yeah. Thank you too, man. It's apes together strong.
As always. So we'll close it off there. And again, like I said, this probably won't be the first time that you see True Demon, guys, because I'm going to go ahead and beg him to come back, and we're going to talk about some other stuff. So with that being said, we'll end it here, man. I appreciate it.
Thank you very much. It was a pleasure.
All right, everybody. Love you long time. Peace.